Hey there, everyone. Happy Thursday, February 19th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of beautifully sunny but kind of chilly Redmond, Washington. I hope you guys are all doing well wherever you're tuning in from. Thanks so much for those of you that attended our free webcast earlier today called The Calm Before the Turn, talking about late cycle leadership sector rotation. It was a lot of fun, to be honest with you. I enjoyed putting that presentation together. Some really thoughtful questions during the presentation, which we were able to get to. If you missed the event, you can still check out the replay through the end of February at marketmisbehavior.com/calm, CALM. Check it out. Hopefully you'll find it an interesting webcast and gives you some things to think about here as the month of February progresses. So we talked in that webcast about some of the topping signs that we've been observing, particularly how value-oriented sectors and now more defensive sectors are starting to improve. As we go into the market recap today, you're going to find that those leadership themes, particularly in defensive areas, particularly in cyclical areas, still very much at the top of the leaderboard. You're going to find that the major averages felt pretty heavy today, even though the last hour had a nice sort of bounce. We are still sort of languishing in this no man's land. We're in the wilderness, waiting for one side or the other to take control. I think the market's decidedly neutral. The great thing about the market in a sideways trend, the great thing about the equity markets in a consolidation phase is, as a stock picker, if you're able to make bets on individual stocks or ETFs, there are plenty of opportunities. There are plenty of things that are working on the upside and the downside. Underneath the hood, there's plenty of movement. It's just aggregating. It's summing up into a major index that is sideways. But opportunities are there. And hopefully what we do on the show here can be part of your process, your daily exercise of identifying interesting ideas and learning a bit about technical analysis. And if anything we share on the show today helps you a bit, I'm pretty thankful for that. Please drop your questions in the comment section on our YouTube channel. We're planning an all mailbag episode on Friday. We'd love to answer one of your questions on the air. With that in mind, shall we talk about the market? So the S&P and the NASDAQ down 0.3% in both cases, mid caps and small caps, pretty much flat for the day. Not a big movement day in terms of the major indexes. The Dow was down the most, and that's only down 0.5% to 49,400 or so. The S&P, couple 140 points away from that 7,000 level. We're at 68, 62 or so. The VIX pushing back above 20, and that's an interesting observation. Yesterday, we'd actually closed back below 20. Today, we're back above there. We're sort of just teasing that red flag level. As we talked about on the webcast today, right, things you look for to validate. If you're nervous about the market going lower from here, good news is the technical analysis toolkit, I would argue, particularly in the US where we've got a very transparent equity market, we've got a lot of data that we can access in terms of breadth data, options data, futures data, sentiment data, volume data. I mean, our cup runneth over with data to analyze for the US equity markets, I would argue. And so volatility is a great thing to monitor. The VIX is one thing that I would keep an eye on. In terms of red flags, VIX starting to accelerate to the upside. It's been trending higher over the last 6 weeks for sure here in 2026, but the VIX pushing above 20 is usually a red flag for me. So we're kind of right at that level where it starts to get a little more uncomfortable. Daily swings in the S&P have been remarkably low here recently, it feels like the calm before the storm, which is why I titled my webcast what I did. I mean, this certainly feels like that quiet period before something starts to happen here. So best thing you can do is define your risk, define your lines in the sand, and monitor them. We'll keep doing so and sharing with you on the show here and through other work if we see anything to warn about. Interest rates, pretty quiet day, to be honest with you. In the bond markets, the TLT was up just slightly. 10-year yield pretty much in line where it was yesterday. So bond markets didn't move a ton. The dollar, not much, up a little bit, but yesterday's move was much higher. Commodity markets a little bit more, particularly crude oil. I would say, even if thinking of things that moved today, crude oil probably at the top of the list. The USO was up 2.25%, making a new swing high. The chart of crude oil really starting to break out of that. We talked about it as maybe a pennant pattern yesterday on the show. We featured that, showed how it's sort of a stepwise motion. Might have been Tuesday's show. Stepwise motion, sort of a consolidation phase. Today, we're actually closing above the upper end of that consolidation phase. So crude oil looks good, and the energy sector continues to impress. Gold and silver both higher, not by much though. GLD and SLV both in the green today. Cryptocurrencies, again, pretty choppy session here. Bitcoin's been range bound in the last 24 hours between 66,000 and 67,000, basically oscillating between those extremes. So relatively flat. Quiet day, to be honest with you, in terms of the general trend in the markets. I think the action today was not at the top level. It was at the bottom level. And that's when I think one of the great benefits if you invest in equities or ETFs is if the major indexes are kind of quiet, there's usually a lot of opportunities to outperform if you just look for the stocks showing strength, particularly relative strength. Anything with the relative strength line going up right now means it's doing better than nothing, right? I mean, because the S&P is giving you nothing. When you're not getting anything in a passive index, go active and find things that are doing better than that. And there are plenty of things out there. I'm not struggling to find those. Looking at the 11 S&P sectors here, you've got Utes at the top of the list. That's one of the more defensive sectors, although certainly some growthiness in the utility sector, given all the AI requirements or AI energy requirements, that is. So the utility sector up 1.1% today. Industrials and energy both up about 0.75%. Only 4 of the 11 S&P sectors were up today. So breadth-wise, not a great day, particularly at the sector level. Look at the stock level breadth here in a moment, but the financial sector, the worst performer, again, down less than 1%, so not too bad, down 0.8%. The XLY, consumer discretionary, down 0.2%. The technology sector, the XLK, down about 0.5%. So the general theme we've been talking about is value and defensives over growth, and today essentially following that general trend. The sector breadth was more negative. The individual stock breadth, a little more neutral, but not great, particularly on the S&P 500, where 59% stocks were down, 41% up. On the New York Composite Index, a little more balanced, 50% down, 47% up. So, overall sort of a, neutral day in terms of the breadth conditions. The breadth overall has remained quite strong, though. And I did grab a chart of stocks above their moving averages. It's just kind of remained relatively steady. Things that are in uptrends are kind of still in uptrends. You're getting some reversal, but there's just so many stocks still doing fine, right? Fine, not great, but fine, right? Doing okay. And okay is not too bad. Let's see, what else can we tell you? Looking at the Magnificent Seven and Friends, a bit of a movement here, particularly on the lower end. You have Apple down 1.4%. Apple struggled here, right? And it came off of that, move up to 280. It's down around 260 here going into the close, bounced off of 255. But I mean, I would say there's a lot less to like in that chart. Netflix down another 1.3%. That has been a consistent underperformer. On the upside, Meta, the best of this group, only up about 0.25%. So not a lot of excitement in the Magnificent Seven names in particular. I think that's it for the high level here. We're going to look at the heat map. As a reminder, heat map is super helpful because particularly on a day like today where the benchmarks were flat, where the breadth was even, where it felt like a lot of things were kind of neutral, something somewhere is moving. So let's focus on what's actionable. Here's the heat map, which is called the market carpet on stockcharts.com. And what jumps out to me immediately, NVIDIA, Microsoft, Broadcom, Amazon, Tesla, Alphabet, Meta, every one of the names, those big growth names that I just mentioned, had a less than 0.2% movement today to the upside or the downside. The biggest mover was Meta, up 0.25%. That was it. So this was a very mild day in terms of the mega cap growth stocks, right? Apple looks like a big outlier, only down 1.4%. So this is a quiet day in the biggest names. So with those benchmarks flat, let's look down then a couple levels and let's see where we see a concentration of red. Let's see where we see concentrations of green. That's where things were moving. So some earnings related plays had some moves today. So John Deere, an earnings name this week, up 11.6%. I have my cheat sheet over here from the Super Bowly stock picking draft that I did with Tom Bowley and Grayson Rose. I'm keeping this just to lament choices that I made that were not as awesome as it could have been. John Deere was on my short list in the industrial sector. I didn't end up picking it, but went elsewhere. I ended up taking Howmet, which is HWM, which is actually still a pretty good chart too, and made new all-time highs earlier this week. But John Deere bouncing higher big time on earnings. That's up another 11.6%. A number of the defense names like LMT having pretty good days. Lockheed Martin made a new all-time high today. PWR, which is Quanta, up 6.7%. That's an earnings name. HII making a new all-time high today as well. So a number of those kind of winning charts in industrials just getting more awesome. Some stocks down, though, particularly the airlines, Delta, United, Southwest, all down about 5% or so. Delta is one of those that's just, it's a concerning chart. And I'll tell you why it's a concerning chart, because things looked really good here in mid-December as we become overbought. That's the sign of a healthy bull market phase, right? New swing highs or we're overbought. We pull back, the RSI holds 40. It's kind of a classic bull market trend. But if you look at the December peak and then look at the early January peak, there's that bearish momentum divergence. We've made another new high around 76. RSI still not overbought. So we're pushing higher in price terms, but the momentum is not suggesting a broad advance. With something like that, I like to look at the volume indicators as well. The volume's been more negative than positive here over the last couple of weeks, right? And that's what the Chaikin money flow is demonstrating. You know, a bull case would be the accumulation distribution trending higher, which would indicate stronger accumulation over time. The Chaikin money flow would be in the green, indicating that over a 1 month look back period, there's been more accumulation, the distribution. Neither of those things are happening. The volume is more negative to slightly lower, which between that and the momentum divergences just makes me skeptical of this push higher in Delta particularly. Some of the other airlines not showing all of those concerning signs, but that's something that jumps out at me. Elsewhere, what else can we say? I mean, within the financial sector, I mean, this sector continues to struggle. You know, and charts like Goldman Sachs aren't horrible charts. They're just sort of languishing, right? They're sort of sitting there in no man's land. Goldman Sachs, I would say, particularly in the short term, is flashing what you'd probably call a pivot point. So a pivot point is where you have sort of a, you know, level of resistance that becomes support. Kind of look at this range right here, and you can see, I think I see what's going on. So here, look how this range just kind of becomes the area. So we spent a bunch of time here in December. We broke briefly above it, and now we're just kind of settling back into this range. We're sort of in this 875 in the lower end, 975 on the upper end. It's just sort of consolidating, and as we're doing that, the momentum is totally drying up. So again, similar to what we've seen with the S&P, even though these charts are not breaking down, they're kind of holding in there, but the momentum is just kind of neutral at best. And I think that's the issue right now with a lot of equity charts. They're just not having that movement. So, you know, a bit of a down day on some of the names, particularly like Blackstone and Apollo Global, with both made new swing lows today. But generally, that's just an underwhelming sector, and the relative strength has really started to deteriorate. Within the technology sector, noting an initial pullback here potentially with Western Digital and Seagate. These have really been some of the stronger charts in technology, as some of the mega cap names have been struggling. These have been holding up pretty well, but so far in February, they're just sort of stalled out here. I mean, this is a stalled out market. What else can we say? I mean, honestly, mixed results in the rest of technology. Semiconductors did not have a particularly good day. I mean, if you're looking for takeaways here, the fact that semiconductors were just kind of not really participating is interesting. On Semiconductor made a new all-time high earlier this week, pulling back today down about 3.6%. Semiconductors are one of those kind of bellwether groups that when they're doing well, it's usually a good sign. Not really getting that. So what else was doing well? Two sectors that stand out among others. I mean, besides industrials, which you already kind of hit on, the energy sector generally doing pretty well with crude oil prices, making a new swing high. And I'm looking at Halliburton, ConocoPhillips, Chevron, all making new 52-week highs today. Oxy having a new bounce to the upside. Also, utilities. Southern is one of the earnings names today, up about 4.4%. Seeing a number of other utility stocks doing quite well. The thing with utilities, right? I mean, something like EIX is up 4.25% today. These are stocks that are generally low volatility. They're not known for having huge price swings, right? They're known more for their dividend. So EIX, which is Edison International, has gone from 46 up to around 73 on an adjusted basis. On an unadjusted basis, it's going to be similar, right? 48 up to 70. There's no real significant change there. But the dividend yield, right, still pays almost a 5% dividend yield, and that's after going up a ton. So down here, when the stock's trading at 46, that dividend yield is much stronger because the dividend yield, right, is the annual dividend versus the stock price, right? Dividend per share divided by price per share. And so 4.8% yield means you're putting, you're buying, whatever, $100 and you're getting $5 back in terms of a dividend payment. Now, on top of that, the price is actually accelerating to the upside. So utilities right now in charts like EIX, you're getting that 1-2 punch of a strong dividend yield, which means good income stream, but also strong capital appreciation. So your principal, your main investment is growing, but also the dividends are paying out pretty well also. So, I mean, pretty impressive. And this is why the relative strength is really starting to go higher. It's not just on the price action, it's the total return that's really starting to impress there. I think that's it with the heat map. Honestly, I mean, to summarize, this is a quiet day. This is a relatively quiet day for major indexes. We're going to spend, we'll look at some macro charts. We'll really spend a lot of the time for the remainder of the show going through individual stocks that were on the move, because I think that's where you've got some good earnings related themes to pay attention to. As a reminder, any questions, any tickers that you're struggling with, any areas of the technical analysis toolkit that you have questions on, please take a moment, drop them in the comments section on our YouTube channel. Helps us to get ideas about what kind of things to cover on the show, but also we're planning an all mailbag episode on Friday, February 20th. We'd love to answer one of your questions as part of that episode tomorrow. All right, continuing on here, the S&P 500 remains range bound. The S&P 500 remains in our neutral area, between 6,550 and 6,900. We've kind of identified that as a general neutral area. 6,800 becoming sort of the short-term level of support. We've now tested that 3 times in the last month. And what that tells me is a break below 6,800 just tells you something's different, right? For now, we're range bound between 6,800 and 7,000. One of those levels is going to give. And I think whichever level between those two gives first, that's going to tell you a lot about the next direction. That's probably the direction of momentum here going into March. And so the danger is a break below 6,800, which I think clears the way to 6,550, and which I think you could reasonably expect a key level of support, this confluence of support with multiple technical indicators. The momentum has been very, very neutral. I think that's another really important thing to watch on the chart of the S&P. We're in a quiet period. We're in the calm before the storm. When the storm hits, it's either going to be a really good storm with the RSI pushing above 60 on a breakout, or a really ugly storm with the RSI pushing below 40 on a breakdown. And I think that is something to watch for very, very closely. Set an alert, just be patient, and we'll see which way this thing breaks. The long-term breadth measures have been remarkably consistent. So as the S&P has been flat, we're holding steady here around 65% of stocks above their 200 day. It's up around 60 to 70%, I should say, in so far this year. And we're up around 66%. So 2 out of every 3 S&P 500 names is above their 200-day moving average. That's pretty good, right? That's good. That's great. That below 50% would be a dangerous sign, but we'd have to have a pretty significant breakdown in breadth to be able to get that indicator down to that point. What would most likely happen first would be the stocks above their 50-day. It's currently around 64%. We're watching that 50% level there as well. Last time we broke below that was in October. That was a big warning sign for us. Ended up being not too painful of a drawdown before the uptrend resumed, but that's where you look for on this chart. So we're getting a slight downtrend in stocks above their 50-day, but just not a lot of things breaking down. So this is less of a bull market over, stocks tanking kind of scenario. It's more of a bull market over for now, but more of a pause button. We're sort of waiting. We're holding our ground and waiting to see what happens next. Almost like the market's holding its breath and waiting to see what emerges. How have sentiment indicators shifted during this sideways consolidation? Well, the bullish reading from the AAII survey has continued to go down over the last 6 weeks. We've gone from almost 50% bulls to down below 35% bulls. Today, in the weekly reading, the number of bears declined slightly to around 37%. So less bulls, less bears, which means from last week to this week, we've got some bears going neutral, some bulls going neutral, sort of lower conviction right now. As you can see, fairly even, about a 2% spread between those two. It's pretty neutral reading more than anything. The name exposure index, which has been generally trending lower. It did tick a bit higher today. Last week it was around 80%. Today it's up around 83%, so a little tick higher here. That's another one to watch as well, because when money managers in this survey get nervous, they start lightening up on their equity position. We've been seeing that as a general trend, but again, kind of holding in there just above 80%, which is pretty good. All right, let's look at some individual names. John Deere, Deere & Company is the official name these days. DE is the ticker. Having a resounding upward swing after earnings today. I think they reported before the open. I can only assume by the fact that it's popping higher today like this. But a nice upward move, around 11.5% for DE. That area in industrials, things like heavy construction names, aerospace defense, a very different group, but those have been quite strong. A number of areas within the industrial sector have been remarkably strong here in 2026. And John Deere, just an exclamation point in that uptrend. Great reminder to not be afraid to buy stocks making new 3-month highs. Not be afraid to buy stocks making new 52-week highs, right? It doesn't always work, right? Sometimes you'll have a breakout like you did in May of 2025, and then that's kind of it. We kind of stall out. But big breaks often lead to much further appreciation. And Deere's strong earnings basically says all this acceleration in January and so far in February have been justified by the fact that expectations continue to impress. So thumbs up on John Deere, still a great chart. Walmart coming off today. This is actually, they reported earnings before the open, down about 1.4% through the course of the trading today. This made a new all-time high last week, pulled back now to the 21-day EMA. So from a technical perspective, I would say still pretty good. 21-day EMA is usually an initial warning sign. As long as we hold that level generally, I would say the chart is still pretty great. We break below that, the 50-day becomes my next level to watch, and we failed that one. I'm usually starting to lighten up a little bit. Overall, this for now looks like a brief pullback within an uptrend phase. The momentum is still good, but the RSI is still above 50. But let's watch those levels of support and certainly watch the momentum. Back to the industrial sector, PWR, which is Quanta Services. I'd mentioned with Deere, other groups within industrials doing well. PWR is in the heavy construction group, making a new all-time high today, up 6.7%. They're another one reporting earnings before the open. So kind of classic cyclical industrials doing quite well. Newmont Mining actually reporting after the close today. Shall we take a look and see how it did? I think so. Actually, hold on. We'll go here. Go to there, and we'll go open a new tab. And then below the chart, we're going to say, show me this. So on stock charts, if you're a stock charts user, go into the symbol summary page. It'll tell you, just confirming that it reported earnings. And then you can also see after hours trading. So after hours, Newmont up 2.4% to around 128. So it looks like here's the chart of Newmont Mining. Whoops. Here's a chart of Newmont Mining. We're up around 128. So we're sort of, just slightly above current levels, sort of just suggesting that this is still a good trend. Chart of gold still looks okay. Gold has been sort of choppy sideways. Newmont Mining actually starting to push to the upside, getting back above the 21-day EMA, which I think is an encouraging sign. Strong earnings today could help propel this a little bit further. Let's see if that's going to follow through. All right, a couple other charts to share with you, and then we'll call it a day here on Thursday. The one is Coinbase. Now, this is a little busier of a chart than I normally like to show, but I just want to share with you how charts and technical analysis, a lot of times just for expediency, right? For brevity, I just analyze the chart quickly which I'm showing you and kind of go through there. But I think there's a lot to learn. Remember that charts are sort of the history lesson for the market, right? Charts are your report card. Charts tell you a ton about how things have moved, and digging into the charts a little further, I think can really help you understand what the path has been for these stocks and just give you a sense, give you context about what we're seeing right now. I've had a lot of questions about cryptocurrencies, Bitcoin down over 50%. So a lot of questions on, should I just be buying Bitcoin because it's down a lot? Listen, I don't blame you. And for retirement accounts, something like that, I think you can make that argument on buying something that's very beaten down because your runway's long enough that you think it's going to recover eventually, and you're not that worried about an entry point. But I did want to share with you the relationship between Coinbase, which reported earnings last week, and Bitcoin, which is in the bottom panel. So this is the chart of Coinbase, and this is a weekly chart going back to its IPO in 2021. Here's the chart of Bitcoin in the middle panel. The bottom panel is showing you the correlation between Coinbase and Bitcoin. Now, you sort of think of Coinbase as a proxy for cryptocurrencies, right? I mean, you're basically betting on the chart of Bitcoin because that's their business, right? Is cryptocurrencies, generally speaking. And that plays out if you look at the correlation at the bottom. We're looking at basically a rolling 20-week correlation between these two data series. And you can see that it's currently at a 0.97, which is about as perfectly positive as you can come up with between two different things. So what that very high and consistently high correlation over the last couple of years means is when Bitcoin's going up, Coinbase is going up, and when Bitcoin's going down, Coinbase is going down. There are random times where that's not been the case, and there's been a bit of a disconnection, but generally that's been a pretty safe bet, strong relationship between those two. However, look at the percentage differences, and I will go back to like 2021 to 2022. Bitcoin went from like 70,000 down to just below 20,000. That's a 78% decline from late 22 to late 23. Bitcoin's down 78%, Coinbase down 92%, right, during that same period on an adjusted basis. On the recovery, you have Bitcoin up 365% from late 2022 to early 2024 during that same period, about a double percentage return, Coinbase going up almost 800%. On these pullbacks in particular, when Coinbase is down 33%, when Bitcoin is down 33%, Coinbase is down 49%. When Bitcoin is down 32%, Coinbase down 59%. When Bitcoin down 53%, Coinbase down almost 70%. So what you're going to find here is basically Coinbase and Bitcoin have a very similar trajectory. They move in very similar fashion. But what I'm showing here with these percentages is that Coinbase is essentially almost a leveraged play on the price of Bitcoin. So if you think Bitcoin is volatile and those big percentage swings are uncomfortable for you, then you probably want to stay far away from Coinbase because it's even worse. It's way worse, often having significantly more swings. So on this most recent drop from September of 25 to February of 26, Bitcoin has lost about 54% of its value, while Coinbase is down almost 70% during that same period. So if you're thinking of making a bet on Bitcoin, remember that buying Coinbase, the stock, means a much more, expect bigger percentage swings. An ETF like GBTC or something, if you ran the same analysis, they're going to be very, very similar in terms of the percentage swings in Bitcoin and the percentage swings in a Bitcoin ETF. Coinbase has ended up being a leverage play. That's really helpful, I think. And this is the percentage change tool that they have on stock charts. The best charting platforms have that kind of percentage change tool where you can really see it. With charts, a lot of times it's just very easy to see these as squiggles that are going up and going down. Thinking of the actual percentage changes can put that into proper context. And I would encourage you to do that analysis on stocks that you're actually trading in. All right, just a chart or two to finish things off. Here's Molson Coors. Earnings were not all great today. Molson Coors actually getting dinged pretty good today, and this is after earnings yesterday. They reported yesterday. Today, big lower open. I just wanted to put this move into proper context. That high that we had about a week ago was actually a really good Fibonacci level. So if you take the April 25 high and the November 25 low, 38.2% of the way up is right around 49.80. That ended up being resistance in mid-January. We then broke above there and went almost exactly to the 61.8% level around 54.30. Got just slightly above there before rotating lower. Now we have the gap lower on earnings. We've held that 61.8% level, and that's what I would be watching, right? So what do you do now that the stock is gapped lower? We gapped below the 200-day moving average, so but closed right at it. So holding that 200-day, I think, would be pretty meaningful. The fact that we've dipped below that 61.8% level, the fact that the RSI is holding just above 40, could be an interesting time to play a potential rally off of that gap lower. However, that 47 level, which would mean a break below that Fibonacci support, if that would happen, I think that would mean more downside potential, and I'd probably be avoiding it. So this is not the classic type of chart I would be interested in. I'm looking more at charts starting to improve and starting to break out. But if you have a good sort of fundamental feel about Molson Coors from a technical perspective, kind of getting down to those clusters of levels where I think the risk versus reward could be pretty interesting. Let's wait to see if some sort of rally materializes and if we're able to see accumulation after that gap. Let's watch the 200-day as well. Final idea here, Extra Space Storage, ticker EXR, reporting after the close today. It's down slightly in the after hours, around 145, we'll call it, kind of sticking right here. This is an interesting setup. We had a break above the 200-day back in October after a bunch of failed tests to get above there. We had another break above the 200-day in mid-January, which failed. We have another break above the 200-day. With things like this, my general approach is, if I'm looking for an entry point, buying the break above the 200-day isn't a bad idea. I don't think that's a horrible idea. Like here, for example, as we made a new swing high, I think that's a pretty encouraging setup. Didn't work because soon after we break below, but that's why we have stops, right? Because we're playing a potential breakout. We want to protect ourselves if that breakout doesn't work. So with this kind of example, buying the breakout, not a bad play, but just make sure we, watch that 200-day and a breakdown indicating a stop, and that's where we would have gotten stopped out. Same thing here, a break above the 200-day fails, break above the 200-day. So my point of this is if the 200-day can hold, that's when this starts to be something different. If we can materialize a break above 150, I think that would be an interesting signal for EXR. I'm going to set an alert there. I'm jotting it down here on a notepad just to make sure that I do it. So I think over 150 could be an interesting breakout. For now, let's see if it can hold that breakout level above the 200-day moving average. Folks, that'll do it. Quiet day for stocks in terms of the indexes. Not so quiet of a day for stocks looking at individual names and ETFs underneath the hood. If there are any charts I didn't show today that you'd love me to take a look at for our mailbag episode tomorrow, make sure you drop a comment on our YouTube channel. Would love to hear from you, and maybe we'll include it in the show tomorrow. For now, I'll say have a wonderful Thursday evening. Thanks, as always, for watching me and my content. Thanks to those of you that participated in our webcast earlier today. If you missed that free session, go to marketmisbehavior.com/calm, CALM. You can still watch the replay here for the next week or two. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts. Have a good night, folks.